We had, I thought, a very interesting discussion. I was just saying to Margaret that the virtue of these discussions is it reminds you that this stuff is really interesting and important and complicated, and very few people can understand it the first time around, so that having these iterative discussions where things come up again, you kind of get it the second time is really useful. It was obvious in the morning, the first part of the thing, that one of the big issues here is what is the role of public policy? What is the role of regulation? How do we structure? We have a fragmented financial regulatory system. We certainly have a common interest in promoting innovation that improves efficiency, promotes financial inclusion, reduces risk. But we also have a common interest in not sinking the financial system or creating a new way for bad people to do bad things. And I think that's a balance. And that's hard even on questions where there is settled technology and the lines of battle are clearly drawn. It is, as Perry said, even harder when you really don't know where this is going. So I want to note that we've been joined by Glenn Hutchins, and we welcome him. What we're going to do now is I've asked Michael Barr of the University of Michigan, formerly of the Treasury, David Mills, who's at the Federal Reserve Board, and Jeff Steem, who's at Promontory but was at the Fed, to talk a little bit about what are the key risks and opportunities here from a public policy point of view. What are the questions that policymakers need to address, which policymakers and when, and so how do we go forward getting the good parts of innovation and not the bad parts? I don't want it to be just the three of them talking, so I want to remind you, if you just put your name card up, I'm happy to call on you, and as you saw before, if you don't put your name card up, I may call on you anyway, so be prepared. Michael, why don't we start with you? Can you help us frame what are the big public policy questions?
Sure. Thanks, David, and thanks to Glenn for supporting this and for the conversation we've had thus far. It's been, I think, really quite enlightening. I want to start really with where we were ending in the last session, and that's thinking about the basic, in a sense, values in the financial system. I think it's underappreciated in general how much of the financial system is based on a simple value of trust. And that's certainly true in the payment system. It's central to the payment system. And the kinds of technologies that we've been talking about this morning are different ways of reinforcing that basic value of trust. And we've talked about two basic types of systems to doing that. One is a closed or a permissive system where all the members of the system are known to each other and are part of a well-functioning group. And the other is an open system that relies on some other motivation to get the participants in the system to behave well. And the particular application of that for Bitcoin is mining and money, in essence. But there are lots of other ways that open autonomous systems in the past have generated trust and participation, including a sense of wanting to be part of a larger community. So the key thing, to me at least, is not about mining versus not mining or permissive versus not permissive, open versus closed. It's how do you establish a community of trust that lets transactions take place? So what I want to try and do is not get into the details of regulatory rules, but talk maybe about some of the potential upsides of the technology for public policy and some of the potential downsides of the technology for public policy. And then we can talk maybe, if people want, in the conversation about the details of who does what to whom and how. To my mind, there are some kinds of applications of this technology that are really quite straightforward, of the kind maybe that Brad and Charlie were talking about, and that I think are exciting because they're in a sense easy use cases, to use the terminology of the morning. And those are the kinds of use cases that improve essentially the efficiency of the existing system. And that's really quite important in the sense that There's a huge amount of waste in the system now, and the waste not only costs a lot of money for people, but makes access issues much more challenging for many participants in our system. So I'll give you, one example is just the efficiency of intra-bank communication. I've spent some time, not nearly as much as anybody else in this room, but some time on the inside of banks looking at their technology. And it's often kind of scary how crazy it is for the legacy systems within banks to talk to each other. And once you move that to cross-border applications within global financial firms, it gets even scarier still. And there's a huge amount that this technology can do to improve the efficiency and security of intra-bank within one system, very closed system efficiency. But taking it a little bit more broadly, I think that this kind of technology, or technology in general, can have the biggest impact when it changes the kinds of questions that you're able to ask about what the financial sector can do. So some examples of that, if we can get to that space, we're certainly not anywhere close to enough of it now. Perry Ann was mentioning applications earlier outside of the financial space in land records, which are a mess in much of the world, or in health records, which are a mess all over the world. Within the financial sector and within the Internet of Value sector, what could we do with this technology to change basic ownership of financial information? Could we use this technology to empower individuals to own their own information and to use their own information to generate their own financial privacy, privacy more generally? Could we use this technology to reduce the cost of transactions such that it would be efficient if I chose to not have to sell my privacy to very large companies and look at their ads in order to use the internet? Could I instead be charged thousandths of a fraction of a penny for a transaction that would be enough compensation so that I could protect my privacy more? So could we use this technology to open up access to the financial system for unbanked households and for poor households throughout the world to send funds, send remittances at much, much lower cost and with much greater security? So can we change the equation of who's in the system using this technology? Can we do much better on really what I think of as quite simple things like the problem of overdraft for consumers by having much more secure, real-time, low-cost transactions, and therefore save $32 billion a year for moderate-income households? Can we use this kind of technology to improve anti-money laundering and anti-terrorist financing oversight? Right now we have, I think, an extremely inefficient, not very good system for catching bad people that also imposes a significant burden on the financial sector. It's got to be the case that with better technology, we can do a better job on that, and it's possible that this more open, transparent ledger system would help us to do that. What about financial stability? It could be the case that using this technology will help both regulators and the market better understand the actual balance sheet and interrelationship among financial institutions. If we have a distributed ledger system, could be the case that it's less likely that we get contagion in the financial system in a panic because people actually see, know, and trust what's going on. And this relates to Lael's earlier question about collateral. If we actually know who owns the collateral and where it is, that could have important financial stability implications. This could, I think David distributed before the panel a nice paper on corporate governance. I think that the technology could improve our ability to have real transparency, less fraud, and more trust in the financial statements and accounting practices of corporate America. And that could be transformative in terms of open access. It could also mean that we have real-time transparency in financial accounting information in corporate America. There's been a lot of discussion about the problem of short-termism, quarterly reporting short-termism in corporate America. And lots of people say, well, maybe we should not reveal everything every quarter. I actually think the opposite is true. I think we'd have a lot less short-termism if we revealed full information every single day. And I would love to see this kind of technology used to improve corporate governance by doing that. All right, so those are some examples I can think of today of the upsides. But, of course, the whole point is that I have no idea. Maybe this technology will be good for those things. Maybe it won't. Maybe it'll be good for things I've never thought of and nobody in this room has thought of yet. What about some of the downsides that I see? One, I think, a very challenging potential downside is a downside that's not unique to a blockchain and distributed ledger technology, but is true of a range of technologies we're seeing today, and is consistent with David's concern that he expressed earlier about artificial intelligence. It's similar to concerns that I have about aspects of high-frequency trading. And that's the peculiar combination that this and other technologies present of automaticity, of immediacy, and of scalability. And the combination of those three factors has wonderful benefits in terms of execution and network effects. But it also may introduce new systemic risks into the system that we really poorly understand. And I think treating this kind of technology or HFT or AI as simply a faster version of what we already do is probably mistaken. And we need to have new ways as people concerned about policy and regulation of thinking about the implications of automaticity and scalability and immediacy for regulation. I think a second big area goes to this question of trust, and that's how do you ensure that the governance mechanisms and the oversight of the system, whether that's a privately generated oversight or publicly generated oversight, reinforce trust, and that the trust ends up being not mistaken. Another obviously concern for regulators is a set of AML, ATF issues, know your customer issues. I think these are actually solvable issues, but they're real. Another area that was mentioned this morning is monetary policy and the implications for monetary policy. I think obviously at the scale that we're talking about today, that's not a live question, but I think it is worth thinking about in 20 or 30 years. We should always have some sense of what private money creation means for monetary policy. But I think this is of the same class that regulators are already struggling with let's say, repo. The concerns with private money creation for Bitcoin are not fundamentally different. The last maybe big category of a potential downside risk that I want to mention is with respect to consumer protection. Most of the areas that we've been talking about and that are like the low-hanging fruit for the technology today don't yet really touch consumers in a fundamental way. but the technology is heading in that direction. And thinking in advance about what the right frameworks are for that, I think, is going to be really essential.
Thank you. Let me turn now to Jeff Stem. Jeff, in the conversation this morning, there was some concern from people in the industry that regulation could stop us from getting the benefits of what could be a great innovation. You've been on both sides of this, and so say what you want, but I hope in your comments you'll also address where you think the most important issues are between the industry and the industry innovators and the regulators and supervisors that we need to think about.
Sure, David, happy to. And I have, as David mentioned, been on both sides of the fence. I'm with Promontory right now, so through our consulting practices, we see a lot of what was discussed around the table on some of these startups and consortium efforts. And in my prior life, before Promontory, spent 30 years at the Federal Reserve Board in their payments oversight, financial infrastructure oversight function, so I've seen it from both sides. I would say, to put it in a real stark contrast, I would say that the cliff that probably where regulatory policy kind of falls off into the void at this point in time is the points that were made by Jerry earlier. It's the open global permissionless ledger, because that gets right to the heart of some of the trust issues, I think, that Michael mentioned. I think backing up from that cliff, some of the use cases within the existing financial services structures that we've been talking about, some of the proof of concepts that are being done and being looked at, whether they're within a banking institution or on a network basis between banks, I think those are less scary to the regulators and to the public policy people. I think, and I would say from my time at the Fed, there was always a kind of objective outlook to kind of try to look at these issues from both a risk management, public policy perspective and an economic efficiency standpoint. So being staffed predominantly by economists, they were always trying to look at those balance points and not just think regulation and not just think, no, don't do that. So I think there is a life cycle, if I could put it that way, of regulatory and policy development that kind of goes on in most of the agencies. At the very beginning of that life cycle is just understanding a new technology, and I think that's where we're at right now. I think that's where some of the agencies are at right now, is really trying to understand, what is this thing, what can it do, what can it not do. I think within that framework of understanding, they are trying to get a better sense of this bifurcation between what is Bitcoin, the virtual currency, and what is blockchain, the technology, and how do they differ? Do they have to go together? Can they be separated? What does that mean? Because the public policy issues associated with a virtual currency, I would argue, and David can talk about this more, are different in many respects than some of the public policy issues dealing with the blockchain technology applied to financial services. So there's that aspect of the life cycle. I think the next stage after gaining greater understanding and inquiry into some of this is really, reactions that will probably come down the line to specific use cases. And those will come along a couple dimensions. One is, who are the entities involved? Are they regulated entities? Are they not regulated entities? How do we think about this in terms of kind of the existing regulatory structure? They'll also be thinking about, do existing regulations allow us the flexibility to do what we need to do without stifling innovation? Or do we have to think blank sheet and come up with something new? There are some things, I think, that they will, across all the use cases, there are some public policy issues that I think come to the forefront. One of those is security, and I know it's been mentioned many times that these ledgers are immutable and unhackable and all of that. I guess I'm from the old school that says if it's in a computer, it can be hacked. So I think there's going to have to be convincing done to non-technologist policymakers that this system is sound and secure, records have integrity, they have confidentiality, et cetera. I think they'll also be very interested, as a general matter from a public policy perspective, financial stability issues, that operationally these technologies are reliable, that you can scale them, that they're not going to crash on you, that they got good quality to them. And I think there's also kind of the general issue, more pronounced when you're talking about Bitcoin, the virtual currency, but also use cases involving financial contracts, as to does the blockchain provide you with a clear attachment of whose liability it is at any point in time so that people can identify that. So if I've got a money value on a blockchain transaction, whose liability is it? Is it my bank's? Is it David's because he sent me some money over a blockchain transaction? And what can I do with that? Can I get access to the banking system to convert it into currency to put in my wallet or something of that nature? From there, I think the progress again is regulators are going to focus most likely on individual use cases. I think they are smart enough to recognize and distinguish between blockchain, the underlying technology and protocols such as the Internet Protocol, versus applications that are going to be built on top of that protocol. And so I think they're most interested in those applications. I don't think they're necessarily, they want to understand the underlying protocol, but I don't think they'll be necessarily rushing to try to regulate the Internet, as was suggested. So they'll be looking at specific use cases, specific applications, specific entities that are in this. To the extent that these use cases are within the existing financial system, they have more comfort with that. They kind of understand the players, the actors, and what this might mean. To the extent it brings in new players from outside the system, that gives them further pause to try to understand how that fits in. What are the risk issues? What are the safety soundness issues? What are some of the other public policy issues that Michael mentioned, from consumer protection to investor protection to those types of issues? So I think, I almost see this as kind of two life cycle waves, kind of not quite in harmony, but they're coursing through the system at the same time. One is just the life cycle of the technology adoption and development for the blockchain and how it's applied in financial services. At the same time, there's a separate life cycle of kind of policy development and regulatory understanding going on. And I think as somebody said, earlier this morning, it really behooves people on the technology and the banking side to be actively talking with the regulators throughout the process and vice versa, so that those two kind of life cycle waves can be as much in sync as possible.
Yes, thanks. So just a little context about the Fed. Since its inception, the Fed has always had as one of its objectives is to promote a safe and efficient payment system. And by payment system, I mean not only dollar value payments, but also clearing and settlement of other financial instruments as well. And we've often looked at innovations within this space over time in a very similar way. It hasn't changed much. So Brian had mentioned a little bit in the first path that we've been through some of this before, and I think history oftentimes helps us kind of see and think and provide a framework around some of the new types of technologies we see today, because a lot of times the issues are still fundamentally the same. In response to that, we often, I often allude to, when I think about Bitcoin and distributed ledgers, often go back to some testimony that then Governor Alan Blinder of the Fed had made in the mid-1990s on electronic money. And so there's a lot of the conversation that we're having today with Bitcoin and distributed ledgers that tie in nicely or fit well in a similar framework to what was mentioned in that testimony in the mid-1990s for electronic money. There, a lot of the concerns or a lot of the thoughts were fairly similar. Some of them, obviously, were centered around private issuers of electronic money and thinking about issues related to monetary policy and the like. Others might be more about what's the underlying technology and how it's used. So at the time, a lot of it was thinking about stored value cards, which we don't see as much of today, but there was a lot of thought about information that was stored on a card and not, in some trusted third party like we see with prepaid cards today. Oftentimes, your account is known by the banks that manage the funds on your behalf. So you go through and you think about some of the issues. Oftentimes it just touches what are the sort of the core issues of money, which you think of as Bitcoin and the asset. But maybe more importantly, and I think for today's discussion and where I think the Fed is putting a lot of focus on, is issues related to the distributed ledger, which is really the payments. I think of the payments value, the way in which value is transferred. Okay, and for that, there are obviously a core set of issues or risks that I think are traditional to any type of system. If you want to think of this at least loosely as a type of system for transacting or transferring value, what are the types of high-level issues that you need to think about? And clearly, a lot of these have been mentioned already. Obviously, one of the main pain points for regulators beyond the Fed as well would be things related to AML, KYC. So that's been talked about, so I won't say much more on that. Consumer protection and fraud is also going to be obviously a big issue, particularly when we're talking about payments that or systems that involve retail transactions and consumers. But some things that we haven't talked a lot about that get more to the element of the way in which value is transferred are legal risks. Right? Knowing how to deal with disputes, resolutions, how to, I think Jeff alluded to it, what do you do when things go wrong, or how do you deal with things that are not necessarily reconciled? In traditional payments and clearing and settlement, these things are obviously a big deal, and I think regulators oftentimes want to make sure that they understand how those types of situations evolve. Another big one, when we think about it, we haven't talked much about yet today, is operational risks. How robust is the system? Oftentimes when I've had companies come in and explain things, they often tell me there's no risk. I don't believe that. And maybe what they mean is they're shifting risk from one party to another. And oftentimes I think regulators really will get some value out of hearing from those who are looking at this type of technology. How do you walk through the transactions process, and where, how the sort of value is, the risks may be transferred across the system. How robust is the system to cybersecurity attacks? In the case of Bitcoin, where you have miners, how robust are they to the 51% attack, and doing the good behavior versus the bad behavior that they may be able to do. So thinking about a lot of the operational risk issues is a big concern, because ultimately when we think about the transfer of any type of value, you're thinking about you're thinking about trust. You're thinking about does the public have trust or confidence in the system, right? And if you don't have an understanding of the operational risks or how robust they are to various types of attacks, it's going to be hard to maintain that trust in transactions. Another element that's important for us to consider as we think about the transfer value, the ledger and the technology, the rails, is settlement risks. Again, what does it put on the demands for liquidity in the very short run, or any type of credit risk that may be extended? As was alluded to before, collateral management. And taken as a whole, I think regulators realize. Certainly. As we have studied that at the Fed, we realize that sometimes this technology actually reduces some of these risks. And other places, they may introduce new pain points. And really, I think those are the things that, when we talk about the rails and the transfer of value, those are the things I think we're really interested in trying to understand, because I think those are important types of risks to ultimately overcome. Finally, it was also mentioned in terms of financial stability. Does it introduce any new systemic risks? Is another thing that we think about. And again, a lot of times there's a scale involved. How big of a system will this be? How big will it become? Does it replace other clearing and settlement arrangements that we have designated as systemically important? What is that? How do we think about financial stability in this, in the interaction? Not only that, but the interaction of these systems with other institutions or other systems that are systemically important from a macro-prudential point of view. And then finally, I think some of the things that get introduced here when we think about distributed ledgers that are worth thinking about, and really with the modernization of payments more generally, is understanding the interaction between banks and non-banks. All right, we often, the banks obviously have a regulatory structure. Non-banks also in this space have a regulatory structure. There's some complexities and interactions there. This may become more and more important as you have technology firms taking up key aspects or key parts of the payments process that need to be thought about and understood. And then finally, as it was mentioned, the role of information in developing these systems. So people have alluded to the fact that you may have better information than we have today from a regulatory point of view, where you might be able to, one, identify bad actors, improve our ability to police AML concerns, or the ability to improve any sort of responses that may need to be made in systemically important events or financial crisis type of situations. Having that information from a regulatory view may be good. How do we understand those limits, or how rich can the information set be? But also, it's a trade-off, and we recognize that it's a trade-off between having a lot of good information and still fundamental values that we know people care about, which is their privacy. And so there's some balance that ultimately is that we'll need to strike, as this space develops. Not that we're in a completely nearly anonymous state, but also maybe not that the government knows everything that you're buying from a pack of chewing gum to whatever else. So I think the role of information is something that is also going to be important here. So, just to sum up, I think it's really going to be helpful for regulators going forward to try to understand the nuances and the complexities and the step-by-step process of what goes on in these types of transactions for whatever use case you're talking about, because these are the kinds of things that regulators will be looking for in terms of the transfer of value. And the more that they understand that, I think the easier it is to have a discussion about what's possible. Thanks.
Robin, you said you had some thoughts on this, so why don't I start you and just say who you are so the web can get you.
Hi, Robin Wiseman from Coin Center. My thoughts sort of echo back to the last panel, but it carries through to this. I think that all the presenters raised some very important issues that we all need to think about. But I feel like when we're talking about the big theme these days seems to be the difference between the blockchain and private blockchains. And that's an important discussion when we're talking about the technology and the development of the technology and VC investment and where this could possibly go and how it might work today. But I think that begins to be a little bit of a dangerous dichotomy when we think about how are we going to look at this in terms of regulation. Because I think it would be a real disservice to the technology for us to pick now, what we're doing with these safer kind of side chains that look a little bit more like a closed system. They're still decentralized. They still have aspects of the blockchain, but it's like the blockchain without any of the scary stuff that you guys were all talking about. At Coin Center, what we want to try to do is figure out where existing rules and regulations, which should be applied and are applicable to a lot of the technologies that are being built on top of the blockchain, where the intent of those we want to get to, but we have to figure out how, with this new technology, we're going to get there. And so really what I was going to say was more of a comment and sort of a hope, optimistically, that when we have this discussion, we're careful not to have, when we have the policy discussion, we're careful not to bring in the Bitcoin blockchain and sidechain blockchain discussion and use that as a way to avoid some of the hard policy questions that we're going to have to consider. So that was more my overall thought than a question.
Margaret? Oh, Michael, do you?
I was just going to say, just to piggyback on Robin's point, that the greatest likely outcome of policy involvement and the biggest danger of policy involvement is locking in the dinosaurs. And yeah, so I agree.
But Charlie made
By the way, can I just say that locking in the dinosaurs is so awesome? When you said it before, I should have referenced that in my conversation.
But Charlie asked a really good question this morning, which is, can we conceive in the current regulatory framework that regulators are going to be comfortable with a public distributed ledger where it's they don't know who's guaranteeing the transaction, right? Or frame the question the way you did, because I want to.
Yeah, no. The question is how long will it take the regulatory community, if at all, to get to the point where they are comfortable with the financial services system? And I'm focusing on financial services, not healthcare and other things,
Right,
but on the financial services system, with various different anonymous players on nodes out on the network being relied upon to come to consensus and validate transactions. I don't have an answer. I haven't got a clue.
Not likely.
But I don't think that should be why we don't try, right? Like, yeah, it's going to be really hard to get people to get comfortable with a decentralized ledger that has to do with transferring people's money right now. I mean, eventually it could be IP, it could be healthcare, it could be whatever. But that's exactly the reason that we need to be having these conversations. That's the reason that Jerry and I sort of wake up every day and go and talk to regulators and and other policymakers and try to begin the conversation of, yeah, this is almost unthinkable right now, but it's happening for real, and it's going to happen whether you do it or whether you don't. So how can we get there?
Margaret Liu, you're with the Conference of State Bank Regulators. So is this a threat or an opportunity?
Yes. This is a great discussion, and I think that between Jeff and David's comments, they really sort of outlined the issues that state regulators, who I'll primarily speak for, but also our federal regulatory partners that we interact with a lot, are trying to wrap our heads around. We are very much at the sort of the learning point of the life cycle that Jeff described. I was really glad to hear Perry Ann's comments about going to North Carolina and sitting down with the regulator. Although I sort of disagree a little bit with the characterization of some of the states criticizing or being unhappy with what New York did. I mean, part of the nature of the state regulatory system is that you do have 50 sovereigns. It's sort of, kind of fundamentally part of, our regulatory structure, the nature of the republic and federalism. And so that's a reality. And it is one that we think in many instances can produce better regulation. We hear, of course, a lot about, the challenges of working with different regulatory regimes, whether that be multiple federal regulators or then you layer in state and federal regulators. But the reality is that it's a big country. There are a lot of different kind of communities and marketplaces, and I think you need that kind of state federal sort of fabric and framework to make it work. The threats are real. There are threats in sort of your traditional incumbent financial services industries, and there are a lot of the same things. The threats are not necessarily different. Consumer threats are really the sort of the areas of concern and the risks you want to manage. Consumer protection, AML. Stability, the stability of the marketplace, the stability of the pipes and the financial infrastructure. Opportunities, definitely, the ones that everyone has identified, and I don't need to go through them again. I think that the work that a lot in the industry, different stakeholders have done, reaching out to regulators, state and federal, is really important. We are all learning. We're learning together. One of the differences, I think, for state regulators is because of the nature of some of the state licensing laws. They're learning, but at the same time, they are, a lot of these entities are coming to state regulators now and have been for the past few years to have the conversation, which is much more of a, it's not so much about Wall Street and all of the sort of interesting things that are being done in that space, but it's about it's much more at the ground level. It is payments, it's consumer payments, and it's the retail use, and it's state regulators' responsibility at that level for protecting consumers and protecting sort of the kind of local financial services marketplace.
Can I ask you a question?
Absolutely.
Just you say who you are and you have to
Sorry.
use the mic.
Hi, I'm Jamie Smith. I'm with Bitfury, and I'm sorry I'm late. But I just had a question for you and maybe the whole group, and I'm new to this world, so forgive me. But are there lessons to be learned, noting that Uber and Airbnb are totally different kinds of companies, but it's still kind of a peer-to-peer, at the very high level, it's similar. Are there lessons to be learned about the way that they misstepped or did things well at the state level that we could take from that, or not at all applicable?
To best answer that, I'd need to know a little bit more about sort of their missteps, other than just sort of what I've read in kind of the mainstream press. It is so hard to answer the question, but I think it's a good one, and we should continue that dialogue.
Yeah.
I have a question if I can raise an issue. Yes, this is Perry Ann Boring, the founder and president of the Chamber of Digital Commerce. And my question's more towards Charlie, the R3 crew, and those working on blockchain for financial institutions. From a regulatory perspective, these are two very different issues, from states dealing with money transmission to financial services entities eventually using blockchain technology for various purposes within the banks for infrastructure. So Charlie, if you could talk a little bit about what type of regulatory challenges that you first see, because I understand you're not looking at necessarily building a payment network, more implementing blockchain or distributed ledger technology as infrastructure within the banking system. So what types of holdups do you expect to see? You mentioned, how long will it be for Washington to get its act together so we can foresee this? But what exactly do you see as your barriers here from a regulatory perspective?
There are thanks for the question. There are substantive ones, and then there are actually process ones. And the process ones, I would sort of turn to the regulators and ask this question. And I lived and worked down here for a long time, and this is a sort of Pollyannish dream that there's an answer to this. The first one is, I don't even know who to call. Do I call Treasury, the Fed, OCC, Consumer Protection, SEC? Who the hell do I call?
Yes.
Right? And right. So unless I've got a lobbying firm on whatever level of retainer is necessary to have a specialist in all these organizations, and that they're on complete message, even if any of these entities, I think, sitting around me would be willing to do whatever it took to get Washington or the states up to speed on what we're doing in a way that was meaningful and helpful. But it's almost like the universe is so big we don't know where to start. And one thing that would be, again, useful, and I recognize this is Pollyannish, is I think the regulatory community would do well to ask itself a process question as to how it, as a whole, to the extent possible, would like to approach this. And Washington's full of task force and blue ribbon commissions, et cetera, I get it. But at the end of the day, and let's just use SEC, CFTC as an example. And this happens a lot, if we're out talking to those two organizations and one of them has a rule on settlement finality, is an example, which is very relevant to what we're doing. If they have two different rules on settlement finality, what do we do? Like, how do we code? I don't know. So I guess the first question to your question is my question to the regulators is, knowing that we will do whatever we can, but not knowing who to call, we will have whatever conversations. But to the extent that we could unify as companies, and that's going to be difficult too, but through organizations, trade associations and chambers of commerce, that we could present a unified front. We need a unified front to talk to. We need an interaction with the government, both federal and state level, in a way that would be meaningful. Because without that, it's like trying to boil the ocean to try to convince the entire U.S. government that what we're doing is the right thing to do. So that's the sort of the process question. The substantive question, and this also breaks down along these regulatory lines, is a concern that the Fed might have about banking is different than a concern the SEC might have about how this impacts securities settlement, which is different than the Federal Protection and Consumer Protection Board has about how I'm protecting retail users of credit cards. I don't know that I could give you my top even 10 list of potential regulatory burdens, given that each of the different agencies themselves has their own top 10 list and none of them overlap, or to the extent they overlap quite differently. So it is quite daunting. And it's no surprise, by the way, that an entire lobbying and political intelligence industry grew up around Dodd-Frank, because there are so many regulatory, and they had to go to the Hill and the White House and the executive agencies and try to figure out, independent agencies, who they needed to try to influence to get that done. It's a booming business. If this technology is what we very much believe it could be, with the potential, and I think I'm looking, it's not the side of the table, but I'm looking at some of the folks that we've been talking with this morning. We all believe in the potential. We wouldn't be risking what we're risking and taking a bet on this in the way that we were if we didn't have a really passionate belief in the potential here, and the potential to do good, and actually the potential to help regulators. But we don't know who to go to, and the list of questions is so long. It's a daunting one. To the extent that we can begin to figure out what that process is, then we can begin to isolate those substantive questions to which you all rightly demand answers, and we would like to give you.
To Charlie's point, this doesn't happen in a vacuum. In the U.S., this is very fragmented, but there are several other countries, and I'll point to the UK specifically, that are streamlining registration processes, creating sandboxes for innovation to occur, and seeking, and I'll speak directly from Ripple, seeking investment and seeking firms to move there to innovate, because they want to lead the way in how the technology takes root. So it is very much a competitiveness dynamic at play globally. The U.S., I think, should very well keep that in the front of their mind.
Okay, Meltem, and identify yourself.
Yes, so Meltem Demirs, and I work with our portfolio companies and investors at Digital Currency Group. So as we said earlier, we have 60 companies in our portfolio, from companies like BitPay and Ripple that are represented here today, but also newer companies that are applying blockchain technologies to edge cases and use cases where there isn't a regulatory stance, where there has never been regulation, that are so far outside what we know and what we think about when we think about regulation. So to Ryan's point, I think what the UK has done is great. The FCA has a body that startups can go to, innovators can go to, and say, here's the use case, here's the product I'm building, here's the technology, which regulators should I think about? And I think the work that Coin Center and the Chamber and other trade organizations are doing to start to define what regulators you need to think about working with, and taking an approach of sort of proactively approaching regulators, saying here's what we're doing, and taking almost a cautious stance where you approach and sort of ask for permission rather than forgiveness. I think that's what we really need to see, and part of that is bringing everyone together and ensuring that we have a unified front, not just as an industry and as a set of companies, but also ensuring we have that same counterpart. And that's why these discussions are so important, to make sure that when companies come to me, come to us, come to their investors and say, this is what we need help with, we're able to say, here's who you should be speaking with. And so more of that would really benefit everyone.
Stephen?
Yeah, Stephen Pear from BitPay. I wanted to make a comment on this notion of getting comfortable with a permissionless system like Bitcoin. One possible outcome is that Bitcoin does for commerce what oil does for the transportation industry, and to say that a bank might never get comfortable with a permissionless system like Bitcoin, to me sounds kind of like saying that Shell Oil Company might never get comfortable with petroleum. So I think you have to really think of ways to get comfortable with that permissionless system.
I don't think Charlie's point was so much the banks, but that the regulators, and there's some anxiety.
Well, yeah, but it's the banks, by extension, to the regulatory or the regulations that are in place. The banks are afraid of the regulatory consequences of dealing with a permissionless system like Bitcoin.
Yeah, I mean, if I could address that, if the regulator is already on board with a permissionless system, all right, we're in. but they're not. And one of the concerns, actually, Jamie, you raised it in relation to state level regulators, but the federal could apply with an Uber, for instance, or an Airbnb. In a lot of cases, they asked for forgiveness, not permission. If my banks ask for forgiveness, not for permission, they're out of business. It just doesn't work like that. And therefore, some people might call it hypersensitive, but our clients need to be hyperly sensitive to the concerns of regulators, and therefore, we can't begin to consider moving business onto a public forum and onto a public blockchain unless the regulators have already told us in advance that we can do that. And in advance of that, I can't counsel them to do so.
Michael Barr, you're single-handedly responsible for all the good and bad in Dodd-Frank, so.
Just the bad. I think Charlie's right. We have this, incredibly complicated regulatory system. It's very hard for anybody to navigate. It's certainly not. You wouldn't describe it as a platonic ideal of regulatory organization. I think if we had a different process with the Congress, you might have different outcomes from that. But we have the system we have. There is, I think, some potential for the Financial Stability Oversight Council to take more of a leadership role in this area in bringing the agencies together. The Fed has obviously taken a lead role through this a faster payments task force, which I think is which is super. And there's, I think, underappreciated authority in Dodd-Frank for regulating payment settlements and clearance systems if the FSOC so provides to give that authority to the Fed. And I think this is an area where that would be really quite fruitful.
So I want to sound a
Jerry Brito from Coin Center.
Jerry Brito from Coin Center. I want to sound a note of optimism here. I don't think that it's right to say that the regulators are not comfortable today and maybe never will be. In fact, I've experienced quite the opposite. Right? If you think about AML and terrorist financing, FinCEN at Treasury was the first agency to really pronounce on this issue. Their March 2013 guidance explained exactly how the Bank Secrecy Act applies to Bitcoin and cryptocurrencies. And since then, they've issued further guidance and work with the industry. And there's still some outstanding issues, but they're being resolved. And today, Bitcoin companies and other cryptocurrency companies are perfectly compliant with Bank Secrecy Act regulations. At the state level, we've worked with CSBS on their a statement of principles that they sought comment from the industry and from states. They produced a framework that states are now looking at. We're working with the Uniform Law Commission, which, by the way, has a process to create a uniform law for digital currency. And we're working with about a half dozen states to produce really good, innovative, friendly legislation that still has consumer protection. We work with the CFPB. And the CFPB, they're incredibly smart, and they know they've taken the time to learn it. And we'll see, the small places where they're going to have concerns. But that's all just the tip of the iceberg. There's a lot more. Certainly, when it has to do with financial stability, I'm happy to see Financial Stability Board having a convening in a couple months about this. So everybody's taking the time to look at it, and I think we are getting comfortable with it, and I think we will. What I fear most is some kind of black swan event that's just going to have everybody overreact. But at the moment, I think we're impatient. I think I wish, maybe we could go to one regulator rather than 50. But, hey, I see the benefits of the 50 as well. We're impatient, but I think ultimately we can get there.
Gordon Workman, a reference is made to the Faster Payments Task Force. I wonder if you could just explain what it is. Is it an attempt to speed the existing payment system so we don't get a new technology, or is it an attempt to embrace a new technology to replace an old one?
Perhaps it's a little bit of both. But
I figured you'd say that.
We do have the Faster Payment Task Force. It's a broadly inclusive, very open and transparent effort, and we have 350 members on that group. As Ryan mentioned, we have a steering committee. He's a member of that, along with about 20 others. Sean Rodriguez leads that effort. But I think we're very open to new technologies, to innovation. Clearly, I don't represent the regulatory or policy side of the Fed. We're more from the services perspective, although the board has taken a great interest in what we're doing. These issues of governance and regulation have been surfaced by our task force members. So we're recognizing that we need to provide a bit more clarity on that going forward. So it is part of the work of our task force. We have a great website, paymentsimprovement.org, and a lot of information about our efforts there.
Glenn Hutchins.
So I should start with a disclaimer that I'm an investor in Bitcoin. In fact, I have two companies here. There are two companies here today that I'm both an investor in and a fiduciary on the board of. I had nothing to do with this, anything other than the session, other than showing up. So, but I just want to make sure everybody knows I have a conflict. Make a couple. My first overwhelming comment here today is, I think it is in the vital interests of the Bitcoin industry to create a compliance and regulatory framework that works, because that's the only way the industry is going to grow. And so there will be frictions associated with getting it right, which I'm going to talk about in a minute, but it's really very important to the industry for this to happen, point one. And from the point of view of both the people in this room and other people I've talked to, I've been very pleasantly surprised by the open-mindedness and willingness to kind of think about this on the part of the regulatory community. So I think I'm very encouraged by the overall reception. And while there'll be friction and dialogue and disagreement, I think the collaborative effort so far has been really terrific. And I just want to compliment everybody in the room who's kind of had a piece of that. I met a company yesterday that I don't know what the right term is. I think they got a license from the CFTC to be a Bitcoin's derivatives exchange. Is that the right thing? Is it with the registration? There's a CFTC person here. Is that the right way to put it?
They have a registration pending with us.
Registration pending, and they've been very complimentary about taking a long time, taking a lot of effort, been very complimentary about the open-mindedness and the willingness of the CFTC to think about that. That's just one of many examples. I think that's kind of point one. The second point I think you have to understand is that as a technology investor, by the way, the reason I'm into this is there's a 5 to 10% chance, I think, that this could be one of the 2 or 3 greatest technological innovations of my lifetime. Reminds me a lot of when I started talking to people 20 years ago about something I then called the infobond, which we now call the internet. They looked at me like I was crazy. And I think there's a 5 to 10% chance that Bitcoin becomes to value what the internet is to information, that we can transfer value around the world instantaneously, basically at no cost, and transform how value is used the way we do with information today. That's a 5% chance, but it's, as an investor, that's kind of a very interesting thing to be invested in. You should understand as a technology investor that almost every single major new technology has been used. The early adopters are the bad guys. It's almost always the case. In fact, many technology investors look to see what the bad guys are doing and to try to figure out how they can adapt it to legitimate uses. So if you look at pornography has been the early adopter of everything from the printing press to video streaming. It didn't stop us from disseminating the written word or the printed word or videos or DVDs or VHS or all those sort of things. We just figured out how to chase down and stop the bad guys. People who study currency today tell me that somewhere between 80 and 90% of U.S. $100 bills are used in organized crime. We still print $100 bills, right? So to look at this and say the bad guys are using it, therefore it has to stop, I think is a failure of pattern recognition and understanding the history of how these things how it worked. We had a session here the other day in which there was this conversation about what is Bitcoin, how does it work, how can we trust it, what other things. And there was an economic historian, I forgot what the session was, I'm trying to remember what the session was exactly about, but he was talking about how there was a discussion 100 years ago, roughly, about what this new thing called a check was. And a very similar discussion, is it really money? Can it be used to exchange? How do you settle it? Where's the credit risk? All this sort of stuff when banks first started introducing checks. So it's a very similar, so these are issues that we've dealt with in the past, and we're dealing with right now. The one thing I will tell you is this is such a fundamental change that the only real use, I don't think the existing regulatory system can be cobbled to make it work. I think the principles of the regulatory system need to be applied to it. The things we've talked about, and I haven't got the list here, but someone had a very good list of consumer protection, AML, stability, all those sorts of things. But then there are going to be very different kinds of adaptations of those principles to this system because it is a fundamental technological change. sort of like the analogy I use for people is sort of like taking the rules associated with mail that attach to post office and applying those to email. It's just kind of so completely different. It's not relevant. But I'll give you a couple other quick thoughts about this. The one thing I say to people is that you have to think about talk first about the ledger, and then secondly about the blockchain, and secondly about the currency. The blockchain has two important features to it. One is the ledger piece, but the other is the technological protocol for the movement of money around. Too many people are focused on the ledger piece of it, which is useful. Not enough people are focused on the technological piece, the Bitcoin protocol, the Bitcoin analog to the Internet protocol. That's the part that's going. If this is going to be transformative, that's going to be the thing that we're going to most experience.
Barry, that's what you meant when you talk about the rails.
Yeah, exactly right. And it's not just and what you're going to say is it's not just the regulators who are going to resist this. It's going to be the people with legacy pools of profitability who don't want those to go away. So the banks and the credit card companies in particular are going to be the biggest resistors of this. They're dipping their toe in with private blockchains, which I call grandma's version of the Bitcoin.
How do you really feel, Glenn?
But they are going to be the big resistors. So one of the most important things about this Fed work on payments, in my view, is take a $100 transaction. The average credit card company takes $2 from you. If you write a check, that's 7.5 cents. Is that right? Roughly, no, it's 15 cents. It's 7.5 it's 0.75%, right? So it's 15 cents. So today, the reason if we modernize ACH and make it available for instant payments, we can take the average cost of a transaction down from a $100 transaction from $2 to 15 cents. Guess who doesn't want that to happen? It's not the regulators. It's American Express. Right, and then if you further take that 15 cents down to thousandths of a cent using Bitcoin technology, you can transform the cost of moving things around. So there's going to be a bunch of legacy people out there who don't want this to happen, not just in the regulatory community. The last thing I will say, and the two things. One is the private ledger, is equivalent to the intranet. Remember when we first had intranets and you could all of a sudden send this thing called email around your office, but if you wanted to go out of your office, you had to use FedEx or mail. And that was kind of good because you could collaborate with the people you worked with, but it didn't transform things until everybody was connected in a seamless World Wide Web. And so to think that we can just have the private blockchain and use that makes the banks happy because they get their cost down. But their legacy profitability pools that moving money around the world aren't kind of endangered that way. So I wouldn't listen much to that kind of stuff. The other thing I say to people is that for the regulators to think about Bitcoin as a currency, i.e. as a gold equivalent. I'm not sure I like the oil analogy. I think a better analogy is copper. In other words, I think that the way to think about the Bitcoin currency unit is more as copper rather than as gold. Copper is a metal people mine. People speculate in it. It has value. It's traded on exchanges, all that kind of stuff. But its fundamental use is to move either electricity or voice messages around. It carries something that we use. And that's what the Bitcoin currency unit is, a means by which, I think the metaphor is, to transfer that value. Right? And so you can't have the system work without the Bitcoin token moving around, just as the way it doesn't work without the ledger, just the way it doesn't work without all moving around. So the way to think about the Bitcoin is an industrial metal that is the modern equivalent of the wiring that makes the system work, and they all have to work together to deliver that piece. So you can't have one without the other, but it's less important as a store of value and more important as a means by which it all hangs together.
Jamie has a question, and then Jeff.
Question for you in the group. Is there a consensus, Jamie Smith Bitfury, is there a consensus on, I like the copper thing, on calling
You have to quote me at least the first time.
I will. And then I'm going to steal it. Is there a consensus on calling it a currency?
I think that's a very good question. I think calling it a currency is sort of a bad way to think about it. I was saying earlier, as we've invented new technologies over the years, you have to use metaphors. When something's brand new, you need a metaphor to explain it to people.
Yeah.
Right, and that gets their mind around it. I mean, we still show, David and I were saying, we still show like a little picture of an address book on some of your Microsoft products when you put something in your context, when it has nothing to do with an address book anymore. You know what I mean? We still show that because that's the metaphor that allows people to understand. Or we show an envelope that looks like literally an envelope. You shouldn't mail it.
Yeah.
Right, we show that because that metaphor helps people understand what they're doing. But we got to get the metaphors right in order for people really understand it.
No, I totally.
And I think you're right.
Yeah.
The currency doesn't really quite get it.
That's what I'm a communicator, so that part is where I'm a little stuck. And I think from a policy standpoint, it raises questions of whether it's actually even harmful to call it a currency or helpful. And I just not expecting a consensus here in this room, but I think at a certain point, us having this community having a position on what we want to call it. Somebody told me yesterday that they actually really like to call it a service, which I think is an interesting approach as well, that Bitcoin's really a service. It's not even, I was calling it a process, but it's actually, he described it as a service. It's just something to think about that, I don't have the answer to, but I'm so curious.
I think there's a disagreement on, Stephen.
I often refer to it as a commodity. It trades like a commodity. It's actually a commodity that makes a payment system work.
And from a regulatory perspective,
well,
is that helpful?
I don't know, but
it
functions like a commodity.
I definitely know I don't know.
I think there's real underlying policy tension that's, it's not, it's a communication issue that embeds a set of policy choices and trade-offs, and that's really, Barry and Charlie were nice to each other in response to my question earlier because they want to get along. But I think there's a fundamental. No, really. I mean, they get along beautifully. But there is a real tension among these different uses for the particular technology. So, and if it's really great as an asset class, it's probably not really great to help service the transactions. So I think it motivates miners, but as sort of a ongoing thing for the betterment of the payment system, there's a limit to that. And the better it is as an asset class, to some extent, the worse it is as a facilitator of broad payment systems. So I think that tension is real, and I think that people don't want to acknowledge it because it has ramifications for investment strategies, but I do think it's a real fundamental question for policy.
Jeff, I'll get you a minute. Barry, do you want to respond to that?
Yes, my company is called Digital Currency Group, and I can tell you, as I was thinking about what to call it, one, I didn't want to call it Bitcoin blah, 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 because we're now 7 years into this experiment, and it's highly likely that Bitcoin will not be the winner. Today, I think it will be, but it's likely it won't be longer term. And I think currency is fairly aspirational for this industry. And I've talked frequently about the promise of Bitcoin as a rail, as a ledger system. It's a very unpopular opinion I'm going to share right now. It's only possible if the monetary base of Bitcoin grows to the point where it could sustain global economy, where there's enough volume and velocity in the exchanging in and out of it to support cross-border payments, remittance, so on and so forth. So that means that it first is being established as a commodity, gold-like. People are buying it, they're hoarding it, they're speculating in it. Price goes up. More people own it, they have wealth. More merchants say, well, all of a sudden there's 20 million people around the world who own 50 billion of Bitcoin. We're going to start accepting it. Well, most merchants who are using BitPay to process those payments are not taking Bitcoin long positions, so they're selling out of it. Creates more volume and velocity, and all of a sudden this flywheel starts to really pick up speed. So there's 20 billion, 50 billion, 100 billion of Bitcoin. You now have 50 million people around the world, 100 million people around the world owning it, spending it, using it, and that's when the magic happens, in my opinion. That's when you really do have the potential for these rails to get formed, where, as Glenn said, money can move around the world instantaneously and basically free. But it is only possible if you go from Bitcoin at $420 to Bitcoin at $4,000 to Bitcoin something higher. Again, not a very popular opinion, but I think it's the reality. One other observation I'll make, I guess this is the policy regulatory part of the conversation. If we decided today, this is how we're going to regulate it, this is how we're going to define it, let's get it done. Best case, 3 years before we actually have something that the companies can follow. And so I hope regulators appreciate that the industry, entrepreneurs are not going to sit back and wait for those decisions to get made. And I think hopefully everybody can appreciate that we're doing our best, and we're trying to be helpful, we're trying to engage, but the expectation cannot be we're going to wait for clarity.
That implies you have a choice. Jeff, you had your...
Yeah, I wanted to go back, I think, to some earlier comments that Charlie was making about, how do you even get started in this regulatory game, given the number of agencies in this city and the number of law firms and stuff. And I think it may be helpful to take a step back and just try to put ourselves in the shoes of the regulators a lot of times on these types of issues. A new novel idea, novel concept, novel technology comes along. Individual firms start trooping in on their doorstep. Hey, I got a better mousetrap. The regulators are in a difficult position because people are coming in with vague concepts or broad use cases with not much traction to them. They're interested in the taxonomy that David laid out on the different types of risks and some of the other public policy goals like AML and anti-terrorist financing. And so they'll take that lens and they'll say, tell me, how does your better mousetrap fit against these? What types of mice is it going to catch? Will it catch rats? Is it going to be harmful to children? They're going to ask those types of questions about your mousetrap. And oftentimes, at least when I was at the Fed, one of the things we struggled with is people didn't have that level of granularity. They'd come in with a broad concept and they'd want you to opine on it and give you the papal blessing and out the door you would go. So all we could do at that point in time is listen, try to understand, maybe ask follow-up questions. I think I would agree with what Jerry said. Most of the regulators I know at the Fed and the other agencies, they're open to these ideas. They don't wake up in the morning being, want to be resistors to new things and don't want to be resistors to technology. But on the other hand, they have a mandate from the governments, whether it's state or federal, to do certain things and to ensure certain things happen. And so they're trying to thread that needle. It often takes time, it takes information, it takes multiple meetings, which I know from the industry side is always frustrating. In terms of who to talk to, I thought Michael's idea about FSOC's about the only place now that all the financial regulatory agencies come together. On the banking side, there's the FFIEC, which I think the state regulators have a seat at the table on as well. And then you've got the CFTC and the SEC on the market side that's difficult to get to. But who to talk to sometimes depends on what your use case is, getting down to use cases. Am I talking about doing something with swaps contracts? Am I doing something with payments? Go to the Fed and talk to them. The other thing that I think has always been helpful for my ex-Fed days is, having a bunch of individual firms with kind of their individual piece of the competitive pie and their own cut and take on things coming into the regulators can be interesting. It can be helpful. You can start to understand the landscape as a regulator. But, in the back of your minds, the regulators are always saying, okay, this guy's got one ox to gore. This one's got a different one. Entrenched value propositions have a third thing. How am I going to, again, thread that needle? So to the extent that, industry consortiums or industry trade groups or something of that nature kind of coalesces some of this information and opinion and approaches these agencies either individually or collectively is also a huge, huge benefit to move things along, I think.
The point you made about use cases drives what regulators to go to.
This is Charlie Cooper from
Oh,
R3.
sorry, Charlie Cooper from R3. The point you made about use cases driving which regulator to go to is actually really interesting because that's a regulatory model driving a business model. Meaning, if I want to bring distributed ledger technology writ large to the financial services community, it's too difficult, it's not worth trying. So what the regulatory community is encouraging me to do is build products up the stack commercial applications that solve a commodities problem or a securities problem or a payments problem, et cetera. And therefore, the underlying network solution is not being worked out. I'm building applications up top, and that may be fine. But the second thing that the fractured regulatory environment does is, because it takes longer to get to consensus, to the point made about protecting the dinosaurs, the startups will run out of runway. The companies that will remain standing 5 years from now are the big tech companies or the banks, whomever your villain is, who can wait until this has sorted itself out and they have plenty of money, and then they decide what they want to do. And the real entrepreneurs, the people now, whether they're pro-Bitcoin, the currency, or not, is irrelevant for this conversation. Those real entrepreneurs that are out there trying to make a go of it are going to suffer because they don't have enough money to make it 3 years. And that's maybe just where we are. It may be a recognition, but there's a perception, I think, outside Washington that regulation harms, that regulation itself harms industrial growth, entrepreneurship, et cetera. I'd make the counter argument. It's regulatory uncertainty that causes that harm. If we knew what the regs were, we could operate within them today and build business models in that context today. But unfortunately, because we don't know and everyone's kind of looking at each other trying to figure it out, I mean, this currency commodity thing is fascinating. If I have it right, I could be wrong. I think the IRS has already called it a currency and the CFTC might have called it a commodity. All right. And it's property in Japan. I didn't even know that. So, wow. All right, now what
I think
do
that this
do?
goes, I think it's a fundamental point. So, first of all, this has a lot to the choice of metaphor. I really do think that what the internet metaphor doesn't work is that it was allowed to grow in a space that was largely nobody regulated it, so it could evolve. Secondly, I think some of this resembles to me the controversy over the Food and Drug Administration, where there's this constant tension. We want all new drugs to be sped to the market as quickly as possible, and we don't want any bad drug to ever get to the market. And you can see the pendulum swing in criticism of the FDA. You can have the same member of Congress criticize them on Monday for letting some bad thing through and criticize them on Tuesday. And they try to deal with the biologics and the medical devices and how do we fit them into our regulatory framework. I think that we could all agree here that nobody in their right mind would design the financial regulatory system we have in the United States now, and that is nothing to do with Bitcoin and distributed ledger. I haven't heard anybody defend it from the existing banking industry, but you can't say to David Mills, gosh, it would be great if the CFPB, the OCC, the CFTC, and the SEC would delegate all their authority to you so I can get a straight answer. So I think the real challenge, you can say, well, you can say it to him, but I can imagine, I can just imagine Scott Alvarez's response. Yeah, I suppose Scott, you're right. Scott Alvarez is the one who thinks that the Fed does already control everything, right? So I'm trying to figure out what, David Mills, what do you do if you're constrained? We live in a democracy, and you're constrained by the laws that Congress has written. Congress did not anticipate this. Congress isn't even very good at writing laws to deal with anticipated developments. How do you, when people come in and say, gosh, we have something here that could really make the payment system work better, and you have to know that there's tensions within the legislative and regulatory framework, how do you react to that? What do you say to them other than, it sucks and I feel your pain? But here's the 16 steps.
I do. Sorry, Jamie Smith, one last time at Bitferian. I'm so sorry to interrupt, but I do think that as somebody who comes to this space as an outsider who I think sees the world not from a technological standpoint, and I used to work at the White House, communicator, blah, blah, blah. I think that underestimating how little anybody knows about any of this is a strategic mistake. I think that people would be you guys have been in this space for a few years. You live and breathe this. You talk in a way that makes sense to you. But I think you would be incredibly shocked by how few people in very prominent jobs have never even heard the word blockchain. Literally have no idea what you're talking about. And making an assumption that a member of Congress knows what you're talking about or any of this is a mistake. I think starting at ABC is going to be really, really critical. Otherwise, what I've seen over the last 20 years is that if people don't understand, they're going to legislate it anyway. And that's when it gets dangerous, is that they're actually going to start doing things that are totally irresponsible accidentally.
Great. Before I turn to you, David, I want to give Fabrice a chance to defend the U.S. Congress.
And I used to work there. God bless him. I love him.
Not going to do that right now.
Introduce yourself, though.
Absolutely. So Fabrice Coles, thanks very much for having me on from Senator Gary Peters' office. He's the co-founder of the Senate Payments Innovation Caucus. So thanks very much for having this. This is an incredibly important conversation with some great perspectives. I just wanted to weigh in full support of what Glenn said about offering up kind of an affirmative legal framework. I think that's incredibly important. To kind of really provide the parameters for the conversation going forward. I think that, in light of what Jerry said earlier, I think the Black Swan event should be a concern for everybody. Because certainly if somebody loses some of their Bitcoin in some kind of nefarious occurrence, they will certainly be calling their congressional representative. And to your point, if there isn't the education and the efforts made up front, if that doesn't take place, you're just going to have whatever happens. And I guarantee you it's the press reports that will define the understanding. And I think that, the counter-terror financing is a good example of that. After Paris occurred, I read about, Bitcoin being used by the terrorists in Reuters. And if I wasn't a reader of CoinDesk, I would never have known that the FinCEN official, kind of made the point that it was no more risky than some other kind of transaction media. So, I think that offering up an affirmative legal framework would be incredibly helpful to people like me who are staffing my boss when these conversations come up. And I think, for the industry, I'm sure it would be helpful to define, and offer up a wish list. What would you like to see? And obviously, you're not going to get 100% of what you want. That's highly unlikely. But at least it's a starter, and we know where you're coming from. And I think that's just kind of helpful from kind of staffers and congressional perspectives.
Jerry,
So.
Michael, and then David Mills.
So just want to say that we are doing that. So at Coin Center, for example, we have our consumer protection framework, which includes some legislative language. And we're sharing this particularly with the states, because that's where the action is happening vis-a-vis consumer protection. We'll very soon be releasing a framework about securities regulation. The piece, though, is that there's not one framework that you can put forward, because we do have these disparate regulators who are looking at this as different buckets. And as you say, David, we're not going to sort of consolidate in the way that the UK government can sort of have one government with one regulator and then point you in the right direction. So, look, I think we can't, that's out of the question. We're not going to be able to get one framework and one regulator. What we can do, however, is encourage the regulators that do exist is to coordinate, but also to make sure they do not take a precautionary approach and instead take a deliberative and consultative approach, which I'm happy to say is what I have been seeing. But yeah, those frameworks are there, and I've seen folks become increasingly optimistic about them.
Michael Barr.
Just to reiterate, we have a fractured regulatory system, but I do think that if the federal government wanted to go in this direction, there are authorities under the Dodd-Frank Act that the FSOC, Financial Stability Oversight Council, could exercise to give the Fed enhanced authority over this area. And I think it's worth at least having the FSOC explore that now, not take a decision on it necessarily, but have that integrated into the process so that if they decide in a few years that the Fed is the right place to house an overview of this area and to develop new rules for it, that they could.
But
I'm looking forward to the industry going to the FSOC and saying, please, put us under the umbrella of the Fed.
But you're still going to have different use cases.
Right.
The CFTC.
Yeah, it's not going to change the underlying nature that the Consumer Financial Protection Bureau is going to have one set of concerns. The SEC, the CFTC will have others. The IRS certainly, FinCEN for sure. Different perspectives. I don't think that's unhealthy to have those different perspectives, but it does require a lot more work on behalf of participants in this sector to navigate.
Margaret, and then I'm going to not let David off the hook, although I mean, there's a conspiracy against me.
I'll be happy to pass it back to Dave. You know, I think that the discussion today illustrates that you know, I do not think that one-stop shopping is a solution to the problems. I mean, when you look at the different perspectives reflected in the industry and what Jerry was talking about, you know, permissionless, you know, open, closed. Is it a currency? Is it a commodity? And these are the industry participants themselves saying this. It's like the old, you know, kind of cliche about, you know, a bunch of blind people around an elephant, right? It's, you know, because I think it's all of these things, depending, and I think that is what is transformative about it. That is what is fascinating about it, but that is also what makes it so hard for anybody, certainly regulators who have specific, you know, statutory mandates to fulfill, to move forward. And Jeff described the regulatory perspective really well. Certainly, he described really. You'd think he came out of a state regulatory agency in terms of being deliberative. That was a compliment.
This being Washington, you have to make that clear.
You know, being concerned very much about unintended consequences, and I think the frustration about regulatory uncertainty, you know, that's one side of the coin. The other coin is that regulators are very concerned about unintended consequences and, you know, understanding fully what they're doing. And when you have new companies emerging, new business models, you know, individual companies changing their own business models so quickly, it is, you know, it's a huge challenge. I don't have any great solutions, but, you know, I think that what we see here is the fact that there is a lot of you know, immaturity in the industry, in the technology, in the use cases, and so, you know, we can't. I think a one-stop shopping approach is idealistic and won't solve all the challenges that the industry is trying to solve.
Right, but I think part of the argument is, whatever you do, don't screw it up before we figure out what it is. David Mills.
Right, and frankly, the concern about, I think it's human nature. If you're concerned about not screwing up, you're going to be cautious. You're going to be slow. You are going to continue to try to learn before you move forward, because the consequences, and, you know, for regulators and regulatory agencies, those consequences are significant, and they can be very, you know, public in a bad way.
David.
So, you know, we definitely hear those kinds of complaints. I think we recognize them. It's a, you know, we have a decentralized regulatory environment. That's the reality that we're in. But I think Jamie's suggestion of, you know, really educating all parties is part of the solution to dealing with that challenge. I mean, when I first got into looking into digital currencies and distributed ledgers, I mean, very quickly I recognized that there was a lot of noise. I mean, and what I mean by noise is that there were no frameworks or ways to understand what was going on, you know, and it takes people with a lot of time and energy and resources really to put put a lot of effort into understanding really what this is about. I mean, and I think regulators, you know, the Fed included, we're all trying to still figure a lot of things out. We have a lot more questions than we have answers, but I think, you know, to Jerry's point, you know, we're very open and we want to learn, and learning is, you know, what's complex about it, and even within an organization, the learning isn't just in one place. That's part of the challenge, right? I mean, you have your policy folks, you have your supervisors and examiners. They're not always in the same, you know, there's a wall sometimes that separates them, and you know, the policy people may really understand what's going on, but the examiners may have no clue. I mean, and these are the people on the front lines when you're talking to banks, right? And so there really is a challenge that you face, but I think it really is trying to boil it down and talk to a lot of people and really try to get them to understand that there's more behind all the noise. And the noise can be, you know, evangelization, you know, where somebody tells me there's no risk, to, you know, oh my gosh, you know, we can't do anything because, you know, there's this anonymity, right? The truth is oftentimes in between those extremes, right? And so really that's what we need to kind of get down to and understand. And there's just a lot of people that need to get there. And we're just, I think to Jamie's point, there's a lot of people that don't know how to sift through all that noise. And really it's incumbent on the industry to help, you know, calm that noise down and make sense out of it for regulators.
Right, I think that's one of our objectives here today. Sri?
So, Sai Srinivasan, CFTC. So here's an idea I've been sort of sharing with folks from the industry, which is if just building on some of the regulatory challenges. So there's an opportunity here to make the regulator an early adopter of the technology. Right? So what if the industry could develop I don't know, a white label blockchain platform, right? It could be a private chain, and teach us how to use it, I guess, and deploy it within our organizations, wherein the examiners, the policy guys, the attorneys, everybody starts using it, right? So maybe this is something where a forum can be developed wherein, first of all, the technology needs to be there, which is sort of deployable as sort of a pilot within our organizations. We're all come in different shapes and sizes. We're really small. The Fed is big. SEC is big. But this is in terms of, if you want the regulator, this is a complex issue. The technology is new, then there's some trust and other protocols just puts fear in the minds of some of us. And the 12 blind men and the elephant is a good analogy. And we're also resource constrained, right? So I'm just throwing an idea. It'll be good to have some conversation in terms of, how do you make the regulator an early adopter and user of the technology, so that there's no reason. There's a lot of information that flows through our organizations. There's a lot of pieces of information. There's a lot of transactions happening within our organizations, and if the technology is so wonderful, then we should also be using it, right? We use email, we use we use social media, we use a lot of these things. So why can't we also use this technology within our organizations?
Okay. Jerry, do you have any concluding thoughts before I go to the logistics?
Just short that, look, I'm definitely, obviously, in the camp where I think that this is a really revolutionary, transformative technology on par with the internet. And like the internet, when we thought about what was it and how do we treat it, whether just as a user or as a regulator, was the internet, when you were thinking about it for the first time in the 80s and early 90s, was it a television? Was it a newspaper? Was it a telephone? It was all of these things. And you're definitely right that with the internet, these were each unregulated spaces. Although I have to point out, for example, telephone wasn't, right?
Right.
And there were
Problems
challenges there with VoIP. And so the question we have to ask ourselves is, you have all these different use cases and so many different things. Can we solve the fractured nature of a regulatory system so that we have one regulator that can look at it holistically? Probably not. And so I think the alternative is to provide not just one framework, but many frameworks, and to sort of take a page from, again, the Clinton administration white paper on e-commerce that looked at that early internet and said, look, this can be many different things. So the approach we're going to take is to not be precautionary about it, not say, no, and then we're going to permission and allow in certain features. We're going to say, we're going to allow everything, and then as certain things show signs of risk, then we'll come in there with a tailored solution for each of these. That's the approach that I hope folks begin to think about.
Good luck. All right, so here's the
Having
deal.
Success.
Here's the deal. So when we move to this afternoon's thing, it's really my attempt to capture some of the spirit of this conversation in a way that people who are even less familiar with this than I can understand. We have asked Michael Barr, Brad Peterson, Barry Silbert, and Margaret Liu to be on the stage, but I'm going to try and avoid this thing where we have a conversation on the stage and then we turn to the audience. So I'm going to look to the people who are here, who stay, who want to say something, to feel free to raise your hand and interrupt, and we'll figure out some way to get a mic to you. Carrie, my colleague Carrie Granis tells me it's going to be kind of full, and we want to save seats for the people who are able to stay for this afternoon. So if you're planning to stay and join us at 1:15, if you just raise your hand so she knows how many seats we need to save. Keep them up, because she's counting. Okay. All right. So, Carrie, remind me what happens here. The lunch is across. And then we resume at 1:15. All right, I just want to say one word of real deep gratitude. This is a bit of an experiment and high wire act for us. The Hutchins Center hasn't done anything like this before, and it's an area in which we have very little expertise. So I want to thank Seth in particular, my colleagues, Carrie, Peter, Brendan, and Lilia for helping with the making this happen. But mostly I want to thank the people who took a risk and came, spent a lot of time. And I think it turned out to be a really interesting conversation. I hope you've agreed, but I really appreciate all your willingness to talk and be candid and be polite and civil at the same time. So thank you.
Thank you, guys.